Imagine waking up one day and realizing that with just $10 you could own a piece of Tesla, Apple, or Amazon. Sounds incredible, right? But that's exactly how the stock market works. Every day, millions of people, both beginners and professionals, are buying and selling shares, trying to build wealth, secure their future, or even become financially independent. Yet, for most people, the stock market is a complete mystery. They think it's only for Wall Street insiders, that it's too complicated, or even worse, that it's just gambling. And that's where most people are wrong. The truth is, the stock market is one of the most powerful wealth-building tools in history. If you understand how it works, you can take advantage of the same strategies that made Warren Buffett, Peter Lynch, and thousands of everyday investors rich. But here's the problem. Most people never learn how the stock market actually works. Schools don't teach it, and mainstream media makes it seem risky and unpredictable. So, people either avoid investing completely or make critical mistakes that cost them money. That's why in today's video, I'm going to break down exactly how the stock market works step by step. Here's what you'll learn by the end of this video: what the stock market is and how it functions, what makes stock prices go up and down, how companies raise money through shares and IPOs, how investors actually make money, and what separates winners from losers. And most importantly, the biggest mistakes beginners make and how you can avoid them. By the time you finish this video, you'll understand exactly how the market operates and how you can start investing with confidence, even if you have zero experience today. So grab a notebook, because this is going to be a game changer. Let's dive in. What if I told you that every day, trillions of dollars flow through a global system where businesses and investors trade ownership of the world's biggest companies? This system is called the stock market. Now, when most people hear stock market, they think of fast-talking traders on Wall Street, staring at screens, making millions in seconds. But that's just a small part of the story. In reality, the stock market is not just for billionaires or investment banks. It's for anyone who wants to build wealth. And yes, that includes you. But what exactly is the stock market, and why does it exist? At its core, the stock market is a marketplace where people buy and sell shares of publicly traded companies. These shares, also called stocks, represent ownership in a company. When you own stock, you own a piece of that business, no matter how small. Why does the stock market exist? The stock market exists for two main reasons. One, to help companies raise money to grow their business. Two, to allow investors to buy into these businesses and make money as they grow. For companies, selling stocks is a way to raise capital without taking on debt. Instead of borrowing from banks, they sell pieces of their company to the public. Investors, in return, hope that the company will succeed, making their shares more valuable over time. Think of it like this. Imagine you and two friends want to open a coffee shop, but you need $100,000 to get started. Instead of taking out a loan, you divide the business into 100 shares, each worth $1,000. You keep some shares for yourself and sell the rest to investors who now own a piece of your coffee shop. If your business becomes successful, those shares become more valuable and the investors make money. This is exactly what happens in the stock market, just on a much larger scale. Where does the stock market exist? There's no single place called the stock market. Instead, stocks are traded on stock exchanges, digital platforms where buyers and sellers meet. The biggest ones in the world are New York Stock Exchange, NYSE, home to companies like Coca-Cola, McDonald's, and Boeing. NASDAQ, the go-to exchange for tech companies like Apple, Microsoft, and Tesla. London Stock Exchange, Tokyo Stock Exchange, and Shanghai Stock Exchange. These serve global investors outside the US. Stock exchanges allow investors anywhere in the world to buy and sell stocks in seconds, using just a smartphone or computer. The scale of the stock market. To understand how massive the stock market is, consider this. The total value of the US stock market is over $50 trillion. The global stock market is worth more than $100 trillion. Every day, over $200 billion worth of stocks are traded. That's more money moving in one day than some countries generate in an entire year. Why should you care? The stock market affects everyone, even if you don't invest. If you have a retirement plan, like a 401k or IRA, your money is already in the stock market. If the stock market crashes, businesses struggle, jobs are lost, and economies slow down. If it thrives, companies expand, wages rise, and new opportunities appear. Simply put, understanding how the stock market works is one of the most powerful financial skills you can learn. And now that you know what the stock market is and why it exists, let's move on to the next big question. How do companies raise money through stocks, and what is an IPO? Have you ever wondered how companies like Apple, Tesla, or Amazon became billion-dollar giants? They didn't start with unlimited cash. At some point, they needed outside money to grow. And one of the biggest ways they raise capital is through the stock market. Many people assume that when a company is successful, it must have had a rich founder or private investors funding it from the start. But that's not always true. Many businesses begin as small startups, and when they need more money to expand, they turn to the stock market to raise funds from public investors. But how does this process work? Let's break it down. What is an IPO? An IPO, or initial public offering, is when a private company decides to sell shares to the public for the first time. Before an IPO, a company is privately owned by founders, early investors, and venture capitalists. But once it goes public, anyone can buy a piece of it through the stock market. Why do companies go public? There are three main reasons a company chooses to sell shares. 1. Raise money for growth. Expanding into new markets, launching new products, or building factories requires huge capital. 2. Increase brand recognition. A public company gets more media coverage, attracting new investors and customers. 3. Allow early investors to cash out. Venture capitalists and private investors want a return on their early investments. For companies, an IPO is like a grand opening event where they sell ownership to raise millions or even billions of dollars. How an IPO works, step by step. Here's what happens when a company decides to go public. 1. Decision to go public. The company works with investment banks like Goldman Sachs or Morgan Stanley to prepare. 2. Valuation process. Bankers analyze the company's revenue, growth potential, and market position to determine a stock price. 3. Investor roadshow. The company pitches its business to large investors before the IPO launch. 4. Shares are offered to the public. The company's stock is listed on an exchange like NASDAQ or NYSE, and trading begins. Once a company goes public, its shares rise and fall based on demand, just like any other stock in the market. Real-life IPO success stories. Some of the most valuable companies today started with small IPOs. Amazon, 1997 IPO, raised just $54 million. Today, Amazon is worth over $1.5 trillion. Google, 2004 IPO, started at $85 per share. If you had invested $1,000 at IPO, it would be worth over $30,000 today. Facebook, 2012 IPO, raised $16 billion. Today, Meta, Facebook, is one of the most valuable companies on the planet. However, not all IPOs are successful. Some companies crash after going public because they can't maintain profitability. What happens after an IPO? Once a company is public, its stock trades daily on the stock market. Investors buy and sell shares, and the company's valuation fluctuates based on market demand, earnings, and future growth potential. Now that we understand how companies raise money through stocks, let's move on to the next big question. What actually makes stock prices go up or down? Have you ever checked a stock price in the morning, only to see it skyrocket or crash by the afternoon? What actually makes stock prices move? Many beginners think stock prices change randomly, almost like a casino. But in reality, the stock market follows specific patterns and rules. Understanding these rules can help you predict trends, avoid unnecessary losses, and make smarter investments. So, what really determines whether a stock price goes up or down? Let's break it down. 1. Supply and demand. The core principle. At its simplest level, stock prices move based on supply and demand. If more people want to buy a stock than sell it, the price goes up. If more people want to sell than buy, the price drops. This is the same concept that applies to real estate, gold, or even sneakers. When demand is high and supply is limited, prices rise. When demand drops, prices fall. Example: in 2021, Tesla's stock surged over 700% in just 1 year. Why? More and more investors wanted a piece of Tesla's future growth, pushing demand higher. On the flip side, when a company struggles or loses investor confidence, demand falls and so does the price. But supply and demand alone don't tell the full story. So, what else moves stock prices? Second, company performance and earnings reports. Imagine you own a bakery. If your sales are growing every year, your business becomes more valuable. But if customers stop buying your bread, your profits drop, and your business loses value. Stocks work the same way. When a company makes more money than expected, investors rush in to buy shares, causing the stock price to rise. But if a company underperforms, investors sell, and the price falls. That's why every quarter, publicly traded companies release earnings reports, showing how much money they made or lost. If profits are higher than expected, stock price rises. If profits are lower than expected, stock price falls. Example: in 2020, Apple reported record-breaking iPhone sales, and its stock jumped 6% in a single day. In contrast, Snapchat's stock dropped 30% overnight after reporting weak advertising revenue in 2022. Earnings reports are critical for understanding stock movements, but they're not the only factor at play. 3. Economic and global events. Sometimes entire markets move based on big economic or political events. Interest rates and inflation. When the government raises interest rates, borrowing becomes more expensive, slowing down company growth. This often causes stocks to fall. Recessions and market crashes. If the economy is struggling, businesses make less money, leading to lower stock prices. Geopolitical events. Wars, trade disputes, or pandemics can create uncertainty, making investors pull money out of stocks. Example: in 2008, the stock market crashed by over 50% due to the financial crisis. In 2020, when the COVID-19 pandemic hit, stocks plummeted but then recovered at record speed, thanks to government stimulus programs. Investors pay close attention to economic indicators to anticipate where the market is heading. Fourth, investor. Sentiment and market psychology. Stock prices don't just move based on logic, they're also driven by emotions. Fear and greed are two of the most powerful forces in the stock market. When investors are optimistic, they buy stocks, driving prices up. When panic sets in, they sell stocks, leading to crashes. Example: the dot-com bubble, 1999 to 2000. Investors became overly optimistic about internet companies, driving stock prices to insane levels before the market collapsed. The GameStop craze, 2021, retail investors on Reddit pushed GameStop's stock up 2,000% in weeks, despite weak business fundamentals. Understanding investor psychology helps you avoid emotional mistakes and invest wisely. What's next? Now that you know what moves stock prices, the next big question is, how do investors actually make money in the stock market? There are two main ways: capital gains and dividends, and in the next section, I'll break down exactly how they work. What if I told you that someone who invested just $1,000 in Amazon's IPO in 1997 would have over $2 million today? Or that an investor who put $10,000 into Apple in 2000 would now have more than $5 million? The stock market isn't just a place to gamble. It's a proven wealth-building tool that has made more millionaires than any other investment vehicle in history. But how exactly do investors make money in the stock market? There are two main ways: capital gains and dividends. Let's break them down. 1. Capital gains. Buying low, selling high. The first and most common way to make money is through capital gains, which simply means buying a stock at a low price and selling it later at a higher price. Imagine you buy a share of Tesla for $50 and sell it years later for $500. That's a 900% return on investment. This is how long-term investors build wealth. Real-life examples of capital gains. Amazon, AMZN. In 1997, Amazon stock was trading at $1.50 per share. Today, it's worth over $3,000 per share. That's a 200,000% return. Apple, AAPL. If you invested $1,000 in Apple in 2000, it would be worth over $5 million today. Netflix, NFLX. In 2002, Netflix's stock was $1 per share. By 2021, it reached $700 per share. But here's the key. Most of these massive gains didn't happen overnight. They took years, sometimes decades. That's why long-term investing is so powerful. 2. Dividends. Passive income from stocks. The second way to make money in the stock market is through dividends, a form of passive income where companies pay you just for holding their stock. What are dividends? A dividend is a portion of a company's profits that is paid to shareholders, usually every 3 months, quarterly. Not all companies pay dividends, but some of the most stable and profitable ones do, rewarding investors for holding their shares long-term. Top dividend stocks. Coca-Cola, KO, has paid dividends for over 100 years. Johnson & Johnson, J&J, consistently increases dividends every year. Realty Income O pays monthly dividends, making it popular for passive income investors. Example: if you invest $100,000 in dividend stocks that yield 4% annually, you'll receive $4,000 per year in passive income without ever selling a single share. Which strategy is better? Both capital gains and dividends are powerful tools, but the best investors use a combination of both. If you're young and want to grow your wealth, focus on high-growth stocks like Tesla, Amazon, or Google. If you want passive income, look for stable dividend-paying companies like Coca-Cola or Johnson & Johnson. The secret to long-term success? Invest in strong companies. Reinvest your dividends. Stay in the market for the long haul. What's next? Now that you know how to make money in the stock market, it's time to talk about something even more important. The biggest mistakes beginners make and how to avoid them. Because no matter how much potential the stock market has, if you make the wrong moves, you can still lose money. And in the next section, we'll break down exactly what you need to watch out for. Did you know that over 90% of beginner investors lose money in their first year? And the worst part? Most of these losses are avoidable. The stock market is one of the most powerful tools for building wealth, but only if you use it correctly. Unfortunately, many beginners jump in without a plan, make emotional decisions, and end up losing money. So let's go over the 3 biggest mistakes that cause beginners to fail so you can avoid them. 1. Trying to time the market. Most people believe they can predict when the market will crash or when a stock will skyrocket. The reality? Even professional investors fail at market timing. The data. A study by Dalbar Research found that the average investor underperforms the market because they constantly buy and sell at the wrong times. If you had invested in the S&P 500 from 2003 to 2023, but missed the 10 best days, your total return would have been cut in half. Even Warren Buffett, one of the greatest investors of all time, says, "The stock market is designed to transfer money from the impatient to the patient." Example: many investors sold everything during the COVID-19 crash in March 2020, thinking the market would collapse further. But just 6 months later, the stock market hit new all-time highs, leaving panic sellers behind. The solution: instead of trying to predict crashes, use dollar-cost averaging, DCA, investing a fixed amount regularly regardless of market conditions. This strategy ensures that you buy both highs and lows, averaging out your costs over time. 2. Investing without research. Would you buy a house without checking its condition, location, or price history? Of course not. But many beginners buy stocks based on hype, rumors, or social media trends, without doing any real research. This is one of the biggest reasons why beginner investors lose money. Common traps, meme stocks. In 2021, stocks like GameStop, GME, and AMC surged over 2,000% due to Reddit traders. But those who bought in at the top lost over 80% of their investment. Pump and dump schemes. Some influencers or groups hype a stock, drive up the price, then sell everything, leaving new investors with losses. Tech bubbles. In the early 2000s, dot-com companies skyrocketed in value, only to crash by 90% when reality set in. Example, Nikola Motors, NKLA, was once valued at $34 billion, despite never producing a single vehicle. When fraud allegations surfaced, its stock collapsed by 95%, wiping out billions. The solution: before buying any stock, always check one company earnings reports. How much profit is the company making? 2 debt levels. Too much debt can be a red flag. 3 industry trends. Is the company growing in a strong sector? 4 competitors. How does it compare to rivals? 3. Panic selling. One of the biggest mistakes beginners make is panic selling, selling stocks in a crash out of fear instead of holding long term. Why panic selling is a bad idea. If your stock drops 50% and you sell, you've locked in your loss. But if you hold through the downturn, history shows that markets almost always recover. Market crash recoveries. In 2008, the market crashed 50%, but those who held their stock saw massive gains in the following decade. After the COVID-19 crash in 2020, the S&P 500 rebounded faster than ever, reaching new highs within months. Example, in 2008, Amazon's stock dropped 60%. Many people panic sold, thinking the company was doomed. But those who held their shares saw their investment grow by over 3,000% in the following years. The solution: don't react emotionally. Market crashes are temporary. Only invest money you won't need for at least 5 to 10 years. What's next? Now that you know the biggest mistakes to avoid, you're already ahead of 90% of new investors. But let's take it one step further. In the final section, we'll wrap up everything we've learned and show you how to take your first steps in the stock market today. Congratulations! You've just taken your first step into understanding one of the most powerful tools for building wealth, the stock market. We've covered a lot of ground in this video. Let's quickly recap what you've learned. Key takeaways. The stock market isn't just for the rich. Anyone can start investing even with small amounts. Stock prices change based on supply and demand, company performance, and global events. The 2 main ways to make money are capital gains and dividends. Avoid common beginner mistakes like timing the market, investing without research, and panic selling. If you remember these principles and apply them, you'll already be ahead of 90% of new investors. But knowledge alone isn't enough. You have to take action. Why start investing now? There's an old saying, the best time to plant a tree was 20 years ago. The second best time is today. The same is true for investing. The longer your money is in the market, the more time it has to grow exponentially. Real life example. If you had invested $1,000 in the S&P 500 30 years ago and never touched it, it would be worth over $15,000 today without doing anything. But if you waited just 10 years to start, your returns would be 50% lower. That's the power of compounding. Small decisions today create massive results in the future. So don't wait for the perfect time. The best time to start is right now. Your next steps. Now that you know how the stock market works, here's what you can do next. 1. Open an investment account. Platforms like Vanguard, Fidelity, or Robinhood allow you to start with as little as $10. 2. Choose your first investment. Start simple. An S&P 500 ETF is a great beginner option. 3. Commit to consistency. Use dollar cost averaging, DCA, and invest a fixed amount every month. Bonus tip: set a personal goal, whether it's saving for retirement, buying a home, or just growing your wealth, a clear goal keeps you motivated. And remember, investing is a marathon, not a sprint. The key to success is staying in the market long term. Join the discussion. Now, I want to hear from you. Question for you. What's the first stock or ETF you'd consider investing in? Or if you've already started, what's the biggest lesson you've learned? Drop your answers in the comments. And if you found this video helpful, hit the like button and subscribe for more investing tips and strategies. I'll see you in the next video, where we'll dive even deeper into smart investing strategies. Until then, happy investing.